Okay, so all right, so good evening once again. Today we are looking at candlestick patterns and trading patterns. So this is an introduction to technical analysis. But before we dive into it, let's have a look at what technical analysis is about. What is technical analysis? Remember, when I was introducing us to market analysis, I told you that market analysis is. Or who can remind me? Yeah, let's have an interaction.
I think market and you said market analysis was the observation of the recent and like the ongoing and recent trends in the market. So you can guide yourself to take an entry or take a position.
Okay, that's great. Yeah. So I remember saying, so Ruben, anything? Let me
Yeah,
know exactly.
market analysis is like top top down approach of breaking down a chart into resulting diagrams. Yeah.
That's beautiful. That's excellent. Yeah. So it's the top to down approach of breaking down. When you hear analysis, is breakdown. For you to break things down is more like analyzing. That's the word for it. So market analysis is the top to down. There's a reason why I chose top to down, because you're analyzing from a higher time frame down to a lower time frame. We'll get to that part. So market analysis is analyzing from top to down. You pay keynotes to details. So you break it down from the bigger picture to a smaller picture. All right. Then it helps you to take a bias, take your position, take your entry in the market, and also aims at making profit. That's the sole aim of analyzing the market. Because if you analyze the market and you're not making profit, something somewhere is wrong. Either one of the three essential keys for trading is missing. So you need to work on it. So that's it. Um, we looked at fundamental analysis. I told us that fundamental analysis is that analysis that has to do with factors, external factors driving or penetrating the market. Factors such as news, disasters, governmental policies, etc., etc. So that's for fundamental. Then I told you technical analysis is that top to down analysis that deals with price action using the chart, symbols, using symbols to interpret the market behavior or structure. So that's what technical analysis is. So you do price action, you do market structure, you use all of the symbols to work around. You use tools like the indicators. All of those are one of the things that constitute technical analysis, and we are diving into it essentially. But before we go into it, let me remind you that you know as we operate in life, every day of our life, somehow we are creating a pattern for ourselves. And you agree with me that if you come from this part of the world, Nigeria and Africa at large, there is always a continuity in patterns, especially if you are a male child, if you are the firstborn. After as a firstborn in a family, according to Apostle Selman, and it's a very adopted strategy which occurs. If it's possible that your firstborn went to school, your first child went to school, and there was a problem with, let's say, graduation, he or she could not graduate, became a dropout. The second one followed that trend and it happened. There's a high chance that you yourself, you might actually fall victim, except you break that barrier through extra work and effort. So it takes extra work and effort, extra factors, some spiritual factors like the God factor, to actually break through an already existing pattern. So patterns are things that happen in our day-to-day lifestyle. In our day-to-day lifestyle. You agree with me that the first day you make your first 10,000 naira, a pattern has been created whereby that 10,000 naira becomes the least, like it pushes you higher for a bigger goal. The same thing applies the first time you break free from being unemployed, you go into the world of laboring. Automatically you become a wage an income earner automatically, whereby once you finish this job, more jobs are coming because experiences are being gathered. That is pattern. So just as it happens, let me share an instance of one pattern we might be familiar with. In the recent World Cup that was played, I think Argentina, Lionel Messi is one person that followed suit a particular pattern. If you checked history of how Maradona won his last World Cup, almost the same occurrences that occurred is how Lionel Messi won his World Cup. Lost his first game, Messi lost his first game, missed a penalty, Maradona missed a penalty, and everything almost happening that same way to crown him a champion at last. So, what am I trying to say in essence? In life, just like we have what we call posterity, we have karma. We, as we live our lives daily, we are creating a pattern for ourselves. We are creating a pattern for our future. That is why people will always tell you, treat your hobby treat your hobby, the things you do frequently, be very conscious of it because those things have a way of repeating. If you find yourself, you wake up in the morning, you are having a lazy feelings, you are sleeping, you are dull, you are lackluster, no brightness, there's a high chance that the next week, Monday, too, you have that same feeling with no zero motivation. So it's for you to watch every of your attitude day to day and daily. So why am I bringing all of these scenarios? Is because of what we are having thus far. Okay. So before the outbreak of coronavirus, it was anticipated or predicted by a scientist, not a scientist, just a regular um, philosopher who happened to be an atheist. He predicted that 10 years subsequently, there's going to be an outbreak of a disease that will storm the world. Why was this so? Because there was a pattern that was created two sequence before then. So I should be showing with PowerPoint, but I didn't create the PowerPoint chart. So please permit me. So what does this actually mean? That it was already predicted. There are certain predictions that come from the study of patterns. We all watch this popular sorry, I'm bringing in stories because I want to lead us into the world of technical analysis and why technical analysis stands true. If you've watched this movie that made people cry at childhood, there was a scene that happened, I think last year, about the boat something something something. I've forgotten. Emma, you can remind me. Emmy, okay. So, like I said, I just forgot the name, right? So it was a normal occurrence whereby there was a shipwreck, and people lost their life.
Titanic.
Titanic,
Titanic.
exactly. Yeah, exactly. So a pattern was created because that was an invention that was supposed to sprung up and at least try to change the narrative of living within the deep sides of the ocean, you get. But when another invention tried to arise, you get, a pattern has been created, and hopefully the next that is coming, if there is no careful or extra effort taken, it will still continue in that same pattern. So there is a likelihood of a repetition of patterns. Also in life, as you are winning in life daily, there are days, there are periods that you just stay and you just get some undue favor, unmerited favor. It just comes, you feel like okay, it's just luck. But because subsequently there is this season of your life that no matter how it is, you can't slack. That is a repetition of activities, a repetition of events. Same thing with Forex trading, which brings us here. So we have all of these chart systems you see here, you see it's digitalized and it's computerized. In the computer world, we understand what they call algorithms. Algorithms are set by set instructions you give to computer to follow. So it repeats, it iterates, it's a loop. It always repeats its occurrence every time. So if you see the charts here, there is nothing new that is happening here except for the intervention of those fundamentals which are news. All right. This system has been structured. Let me come to these indices. Like this one here, this system runs on a frequent algorithm. But because the people back end who owns this deriv understand that there is an algorithm that is initiating this price action, what they do is they carry out what they call monthly maintenance to review the algorithm. But in the forex market, this you get this occurring, there is likely little or no interference with the algorithm or the structure that has been set up. All of this is happening based on a particular structure that has been worked or um, that has been set. All right. So these things are driven by data sets, and you know that the government do not work without data sets. If they go back to their data set and observe that 2013 we're making great financial profit and here we are losing when our revenue we've imputed for maybe interstate revenue to improve the economy is higher, then we should have a higher this thing. Whereas they are dropping, it will trigger them to put more effort to try to break that very bias or let down or setback. So today we'll start technical analysis strictly with candlestick. I want us to understand what each of these candles represent, what each of these candles are, their names, if you need to know, and whenever you see the candlestick, what does it mean? Okay. So in the early days of trading, the only technical analysis people knew was candlestick patterns. It is like a trading strategy. People only use it when, like, that is what was frequently used. That was what people actually knew as at then. Not until people understood that the same way the financial market operates is the same way the normal human life operates. The same behavior, because this market has a behavior, it has an attitude. So that's the same way as human beings have attitude, it's the same way the market have attitude. So a lot of scientists came together, put some studies and theories, they tested it, proven them, and they were working. And some have been working for a long time till now. All right. So we are going to be looking at the candlestick. Let me take you back to the old time religion. That's the old time origin of the trading. That's candlestick. You understand what they actually mean. So here we have let me mention all. I want to list all the candlesticks here. Can you see my screen?
No, 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 we can't.
Sorry, I was not sharing. Man, sorry, please. Thought I was sharing my screen. Okay, can you see my screen now?
Yes, we can. Yes, we can.
Okay, all right. So if we are with a book, let's just start taking them down, because hopefully we'll use this to verify entries. So the first candlestick we have here is what I'll call the hammer. All right, but before the hammer, know that there is what we call bullish candlesticks. Now, bullish candlesticks are these candlesticks you find that are green. What do they actually mean? These are candlesticks that represent a buy action when someone is buying in the market. So that candlestick actually stands for it. You can see whenever the market is going upward, it's a buy action. So that's called a bullish candlestick. We have the bearish candlestick. The bearish candlestick are these red ones that indicates sell action. So let me expand so you get to see. So let's take, for instance, this candlestick. For instance, let me just describe the candlestick body. Now, just like a normal candle is, a normal candle has a body, a normal candle has what they call wicks. If you check the candle properly, the wicks is what lights the candle. That rope that comes, you know, that you find on a candle, a regular candle, is called a wick. So that wick is where you lit a candle from. So it is assumed that as this candle is, it is actually trying to grow or form. But when it starts going down against growth, that means it is burning down. And because it's burning down, it's going to have longer wicks. I don't know if you understand. So these wicks now is an essential part of candles.
Let me come again. Come again.
Okay, yeah, all right. So what I'm saying is that just like your normal candle is, all right, if every candle has a body, that contains wax. All right, then we have the wick itself. Now, if you burn a candle, a normal candle, and by peradventure it melts only the wax of the candle and not just burns itself, it therefore means that the candle is going to at the end generate longer wicks. That rope that comes in candle are called wicks, alright? And this is the body of the candle. So as it is now, as you can see on the screen, the trading candle also have a body. This is it. And it also have what they call wicks. Alright. So if you are defining, if I start this definition that has to do with candle types of candlesticks, I'll be using the body of the candle and the wick to state the differences between the two candles. I don't know if you understand, and their function too. So let's go back to the document here. We have the third one, hammer. What are hammer? They say hammer candlesticks is formed of a short body with a long lower shadow. Let me show you what that means. Let's leave the long grammar. Let me show you an example of hammer. You know how hammer looks like? This is it. You see this red candle here? This is called hammer. How does it mean? You see it has a long wick and it closes. I even forgot to mention. Now every candle has, let me use text. So you see. Alright, note. Every candle has opening, it has an opening and closing. All right, so it has an opening and closing. So let me type. All right, so for every candle to be candle, there is a place it actually started from and there's a place it's actually ending from. So this is the opening, like this candle. Now this candle, this is where the last candle closed. I don't know if you can see my cursor. This candle closed here. The next candle opened at this point, right? Started selling down. Unfortunately, the pressure of the market pushed it up, 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 up. Now it came down and closed at this point. So every candle has opening and closing. As you can see, this opened here, this opened here, this while this closed here, you see it took up and brought down. The same thing happened when this guy closed here. The next one opened immediately above it. This is it. Now, when it opened, it first sold down before pushing up. Now you can notice that most candles in the chart have double-sided wicks. Double-sided wicks. Look at this current candle. This is where the candle opened. You can find, and it's still very full. You get, it has not closed yet, but watch, once this is the timing, we have 8:25 is the countdown. In 8 minutes time this candle will close, so we'll come back and see how it closes. So what am I saying? Every candle should have opening and close. Back to the hammer candle now. The hammer candle is that candle that opens. This is it. This is hammer. It opens at one end but closes full. Let me explain it again. Let me show you an example of hammer candle. This is an example of hammer. All right, a bullish hammer. This guy here, you can see, just like Thor hammer is those that watch Marvel production. So Marvel production, sorry, or this is it. This is the wick of this candle is longer than the body, and this candle is closing full without a wick. This is hammer. I don't know if you see it. Ruben, can we see? Emma, can we see it?
Yes, sir, we can see it.
Yeah, so this is hammer. Such a way that if you turn this, if you invert this, you can hold it like normal hammer. I don't know if you get. So this is bullish hammer. Let's look for a bearish hammer candle so that you find. I'll just show you 3 or 4 candles that are very relevant. The rest are repetitions. So let me show you this guy, okay? This is hammer too. See it. This guy here, you can find where my cursor is. That's hammer. You see
Yeah.
the wick is longer than the body and it closed full. Provided it closed full, it is hammer. Now, when we're trading candlesticks, there is always a particular notion. They tell you that whenever you see a candle closing with hammer, it always show a reverse of movement. In technical, we call it chalk. In technical analysis, we call it chalk. This word, this is called change of character. We'll come to this term. So what this actually means that if a candle closes like here, where you can find hammer, it happens most times. So people use it to interpret. Anywhere you find hammer, a candle close with hammer, it shows a reversed movement. That means the candle is about to go the opposite direction. This is what people believe in. So like here, this is not a complete hammer, but at least something was formed here. You see it. Now it's actually trying to reverse. Let's leave that. Let's see here that this market reverse. You will find hammer somewhere around here. Let's be sure. Let's be sure. Okay. This guy, this guy happened here. Yeah, although it didn't close full. Let's go to somewhere that it's real. Remember candlesticks, the chances of candlestick pattern occurring is just 50%. The probability is 0.5. Or less than, sorry, it's less than 0.5. All right, that's why people stop trading candlestick pattern. So this was what it was believed that anywhere you see hammer, know that that market is approaching a reverse, a long-term reversal move. So this is it. This guy, you can see candle here and the market reverse. Let's go to daily so that you see it for sure. Let it not be that it's only 15 minutes. You find it. Okay. So this before this market moved here, change direction. There is a bullish, this guy, there is hammer in between here. The market changed direction. Already there was already a sign here before this first move, but it was not sufficient. Another one formed hammer and it changed direction. So let's go back, let's go forward. Let's see where there was a strong, okay, yeah, there's a reverse movement here. So let's see the candle, the bullish candle closing before this. At this point, let's see. So now looking here, you see it's not the case here. That's what I'm telling you. It doesn't happen in all cases. All right. So it has a lesser chance of playing out in the market. That's hammer. Now we know what hammer is. Hammer can be bullish, it can be bearish. So what is bullish hammer? Bullish hammer is that is buying, that is formed towards the buy direction. Bearish is the one that initiates the sell move. That's towards the sell direction. That's just the difference. So now here they said the lower shadow must be at least twice the length of the body. You see it. The lower shadow is what I'm calling weak. All right. Then it must be bigger than the body of the candle. That's the law of hammer. We've explained that. Now, a hammer shows that although they were selling pressure during the day, ultimately a strong buying pressure drove the price back up. This is a reverse movement. When you see hammer on your chart, it shows that there is a high chance that market is going to reverse, go the opposite direction. So that's that. Then we have inverted hammer. A less bullish is a blah 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 blah. The only difference between that, the upper body shadow is long, at least twice, while the lower shadow is short. So this one they call it reverse hammer. Okay, whereby it's still hammered though, but it's reversed, whereby this body is longer than the wick and it must close full. If it doesn't close full, it's not hammer. Like this can be a reverse hammer. If you can see my screen, this guy here, this is a body very short. This guy too, there is a wick short. This is the body. So this can be reverse hammer. Yeah, we'll still look at other ones. Now let's move. We have engulfing candle. This is a rally move. So now they said engulfing candle, the bullish engulfing candle is formed of two ticks, two candlesticks, The first candle is a short red body that is completely engulfed by a larger green candle. So this is an example. Three candles constitute an engulfing candle, not just one candle. I used to make this mistake. Three candles make up an engulfing candle. So there must be um, a bearish candle, there must be a long candle. Either of the two, it can be bearish, but the engulfing is the one that sells. Let me show you in the chart. Let's see. Let's see what this is. So here, also the engulfing candle shows reverse direction too, or shows continuity. It shows also shows continuity. So this is it. Let's find it here. This is okay. Let me show you. Let me show you the rules how it applies on the charts. So you get to see. All right. Let's find an engulfing candle. So you get to see. All right. Let's look for it where that occurred. Engulfing candles. Let's look for it in the charts. This happens. It seldom happens. It seldom happens. But when it happens, you find it. So this is okay. Let me use the box icon. I've not even seen it again. I saw it one. Okay. Let's look at this side. I don't know if you've seen where I marked. Alright, so let's have a look here. Okay, let's see if this is engulfing. Let's see. Okay, not. Let's find according to the rules stated. So let me show. Let's see. Just so you just know the names that something like that exists. So let's back test again. Okay. Uh, okay. So a strong shootout. Uh, okay. So this guy here is this is another candle. However, let me not use that. If not, if I use that, you'll be confused. Okay, here exactly. So this point, this becomes an engulfing candle. This guy here. How? This previous candle, the first candle and the next candle on the right, the one on the left and the one on the right, both of them closed at the same point, forming a straight line. But the middle candle here, you know, traded above, traded beyond or traded inside of these guys. I don't know if you get, and it traded so long that it surpassed all of the wicks. So this middle bearish bullish guy is a bullish engulfing candle at that point. Let's see. This is it. So this is it. You see, these two guys needs to trade on the same horizon. These two guys need to trade on the same horizon. You see it, yeah. So this other guy here is trading out and is always longer than the other preceding ones. Hello, people of God. Hello.
We can hear you, sir. We
Yes.
can hear you, sir. I can hear you.
Yeah, sure. So do we understand what the engulfing is? Do we understand what the engulfing candle is?
Yes, sir. Yes, sir. We can. I
O-
can. I
o-
understand.
Okay. Ruben, how about you?
Yes, I understand, sir.
Okay. All right. So let's move on. So the next one is morning star. Leave this piercing line. It's also a two candle made up of a long red. Just let's ignore that. You can read on that much later. So we have the morning star. So the morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three candlestick pattern, one short bodied candle between a long red and a long green candlestick. Traditionally, the star will have no overlap with the longer bodies, blah 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 blah, as the market gaps will close. Let me explain what this all this long grammar is. Just like you have a normal star, just like you have a normal star, a morning star is that candlestick that shows reverse movement. This one happens very frequently, but sometimes you might not be able to detect which is a morning star because it's always confusing. Even myself too, sometimes if I want to follow it strictly, I make a lot of mistakes. So I try to avoid it too, but you can try. So this is a morning star, right? You know, when you have almost similar equal weeks, the top week and the down week having long weeks, and oftentimes it shows the reversal of a market move. It reverses the market move. So it's like a star that shines to give hope. That's why it's called morning star. Then people see as okay, that stuff that comes up and gives a lot of hope. It is called morning star. So this is it. This guy, potential direction, because it has been formed and it is being followed by an engulfing, it is being followed by a rally candle. You see this guy. Let me explain what makes morning star morning star. Let's go back to that guy so you understand. So let's come back here. All right. Where is it? Let's come back. Where is the one I chose the last time? Where is it? You find it very often in formations. You find it very often. Okay, something like this. You find it most more often. So this is it. This guy has been formed. This is the morning star. Now it is followed suit by a bullish candle that trades more than or trades above it. The next following candle must trade above it and close above it too. So when it does this, this candle automatically is a morning star. So it shows a change of direction too in the market. So let's go to the one that shows continuity of market trend. It is called the Golgi or Doji, the Doji candle. Doji candle is very simple. This is dark black crowds. Leave those names. Most are the same thing. Almost all are the same. You can look at it. I recommend Candlestick Bible for you. That book was written very old. That's an old book. You can read the book to learn more of candlesticks and their patterns. All right. But trust me, candlestick patterns is a 50% market feasibility. So this is dodgy. Now this dodgy here is just simple, very simple. When you don't find a body in a candle and it closes like a plus sign, that's dodgy. Example, this guy. You see ba? Example, this guy. What dodgy does oftentimes is to show continuity in market trend. Let's go back again. Let's see. Now, when you find it, it doesn't happen often, especially when you're in a big time frame. You cannot find dodgy easily. But when you see dodgy, it shows that the market is continuing a trend. Like this guy here, this is dodgy. You see the body, you can barely find the body. Yeah, see how it close. A cross sign. Yeah, cross sign, cross sign, cross sign, cross sign, cross sign, cross sign. You know, when you find it anywhere, cross sign, when you find it anywhere you find it, cross sign, just know that a trend is continuing. Something is going to continue. That's what they tell you. So, so this guy is saying that traders should look out for a short to a non-existent body with shadows of varying length. grammar. So the doji candle conveys a struggle between buyers and sellers that results in a no net gain for either side. Alone, a doji is a neutral sign, but it can be found in reversal patterns such as bullish morning star, blah blah blah, and blah. Doji primarily is a continuity. There was a time I traded the pattern so well in this market. So one of the things we looked out for was always dodgy. Okay, Ruben shared something on the platform. Clean. This is beautiful. Yeah, this is a beautiful dodgy. Clean. You see it as clean as it is. It is just a middleman, is a referee in the game. He doesn't take side, but oftentimes it instigates continuity of market. So let's look at another possible ones you can find. So these are the diagrams. This is hammer, right? So you see hammer here coming out, they show you the direction, the reverse direction when it's formed. This is it, a reverse, whether it's up, whether it's down. But once it's formed, the market was on an uptrend, it changes the direction. These are the things you find in Candlestick Bible. So this is it too. You find this guy too, daily morning star. So reverse, this is it. Okay, this is the morning star here closing at equal sides. Then oh nope, this is this middle candle is almost the doji they're trying to represent to you. Here they're interpreting it as opposite. I counter this anyway. But once you start exploring, you know. Now these three consecutive candles, one, two, three, they are always called, there is a name for it. This let me check. I think I missed that. When you see three consecutive like this, one, two, three, it's always engulfing candle. However, it's still an engulfing candle. This guy, it's always made up of three candles, one, two, three. So when it shows like this, it's a rally candle that shows, it also shows continuity in market trend, that okay, this market is going to continue. That's engulfing. So this is it. This, I think I did this earlier on. So when you find nope, it's not supposed to close below. Not supposed to close below. Let me explain that clearly so you don't make mistake and you don't use it against me in the future. Let me explain that again. Alright, so let me show you. Okay, this is it clean. So here, this is an engulfing candle, constitute the next three. This is closed here. This guy traded inside, and this one to the subsequent ones are trading above this guy. This is the engulfing candle, but the subsequent one traded above it, and they are not trading into the midpoint of these candles. You can find them. They are not even near the midpoint of this candle. These are called engulfing candles. So they often show continuity too in trend. So this is it. This is it here coming in, and I think that's that for candlestick. I will employ you to read Candlestick Bible. This is it. This is the book. Anything candlesticks is the Bible you need to read through. Then try to learn. See if I'll drop the book on the group chat so that everybody can download it. So this is it's just a short book. Alright. So download the PDF and get started. This is a candlesticks trading Bible. There are a lot of revised version. Some are updated. So I'll send one when I go through one. I'll send it on the group chat so we can read through at our leisure. But trust me, the four types of candles you need to know, or the five I have mentioned, let me write them so you see. One is you need to know what a bullish candle looks like. Bullish candle. Two, you need to know what bearish is. Very important because these stuff I'll use them in technical. Dodgy, you need to know the morning star. You hear me use it. You need to know an engulfing candle when you see one. Alright. Six, you need to know the hammer candle. So these are the six core candles you need to note, and others not limited to this, you get. So read extra, get to find out more. Like I said, some of these things propels opposite direction, while some continuity of trend, while some are playing neutral in the game. So this is church. We'll look at this later on. Change of character. So that's that. Let's move ahead to the trading patterns now. All right, so I'll touch that for 1 hour and we go on. I remember we talked about support and resistance one time. So we'll quickly look at support and resistance and how it is traded in the market. Is that okay? This is where we'll start our technical analysis proper form. So let's go. Now, I told us that a support in the market is what? A support in the market is assume that you are standing on this floor, this bare floor. That stuff that pushes you against falling, that stuff that holds you up, that point that raises you up, that keeps you up, that keeps you balanced is called a support. That point that gives you a balance is called a support. But that region that prevents evil from coming nigh you is called a resistance. So if you look at this structure, this market is a very clear market. So this is it. Let me use the horizontal line. So when you are marking support and resistance, please use horizontal line. So you have to trace antecedents to what happened in the past because it's most likely going to happen. Let me mark this guy. All right. So this guy has been marked. I can call this my resistance. Now, if you open trading view for the first time, it will tell you look before you leap. If you want to convert that to a layman understanding, it's actually trying to tell you trade what you see. Trading view will advise you not to copy signals from people. Trade the things that you see and you believe. You get. So if you don't see it, you don't it's not advisable you trade it. So as you are growing, you will get to learn. You come up with your strategies. I'll also share mine. So we also confirm them. Alright. The overall thing is for you to win. That's it. So this is it. One, two, three. Now if you look, the last time USD card traded above this point was, let's check the year. Let's start doing history now. Okay, this is where it ends. So you agree with me that ever since you know they brought Canadian dollar into existence, it has never ever in its life traded beyond this point. This becomes a barrier for it. This point is like a barrier for it to break through. It's just like the some people will tell in your family that since this family emerged, nobody has we don't have any graduates before. And you see as the first graduate will struggle all his life. Meanwhile, people are graduating with ease. They are coming out of school with ease without any constraints. But just for the fact that he is the first, there are a lot of struggles. There are a lot of struggles. There are a lot of barriers. They say there's no millionaire in this family. You will struggle before you get through to break through, except external forces like God factor comes in play, like I told you. All right. So here, the external forces are the news, the fundamentals that can come in and stop this from not happening. Okay. But here you can see that since they gave birth to Canadian dollar, it has not traded past this guy. Each time it tries to break free, there is something that pulls it down, it goes back inside. So you can see Canadian dollar has been very poor. The last time it even amounted to this point was 2022. 2 years ago, October 2 years ago that it reached this spot. Now following suit, this is it. 2023, it repeated again. 2024, almost the same time. This is it. 2022 October, 2023 October, it happened. 2024, almost October. This is August. 2 months behind, it happened again. Tried to break free, but it cannot still break free. So automatically this becomes a resistance. You mark it out. So that whenever you are trading, why are you marking this point? So that whenever you are trading, you know that, oh, this point is a point that I should not pass. It will be very foolish for you to set your TP and you take your TP up here, waiting for 700 years or 7,000 years. Meanwhile, you've seen that this point is a resistance to Canadian dollar, but you want to, you just because you've not seen it, some traders will tell you place your TP at 1.141115. You've not even seen that that point is a strong resistance. You foolishly put your money, place your TP here, and until your money don't go. So that's how it happens. Sometimes the trade will get to this point and it will start bouncing back and hit your SL, taking all your money or equity. So things like that happen. You need to be very careful. First thing you look for when trading, you need to find the nearest resistance, whether it is in weekly time frame, daily time frame, 4 hour time frame, 1 hour, 15 hours. Find the nearest resistance. So that's one thing you need to note. Now I'll give us a guide. When I finish brushing everything you need to know, I'll show you how to analyze accurately. Inshallah, God willing, because there's no accurate analyzer, shall but you can still hit it. So the next thing we look at is the support. Hello?
Yes, sir.
Yes, Chief.
I'm just checking that USD card. I think it broke that point.
Okay, the USD card. Yes, this is it. This is 15 minutes. This is 15
I
minutes.
think around May 2020.
Okay, 2020.
Yes.
All right, let's go back. Let's go back. Let's be sure because I didn't actually scroll down, down, down. Let's check quickly. Let's check quickly. Okay, so this is it. 2015, 2020. Okay, you can see it here now. This is it.
Okay.
This is
March. It was March.
yeah, March
Okay.
2020. March 2020 and January 2016. So what happened here was that CAD actually broke through this guy, but the resistance force brought it back inside. This is it. CAD sold above and it brought back. He did here again the same thing. See the same time himself. It happened. He tried again 2022. 2022, he could not even break through. Tried again, he could not break through. So I didn't check all the paths. What am I just saying in essence is that it will be very unwise for you as a trader to place. Why are you checking for resistance? So that you can estimate your nearest TP, your nearest take profit. This is where you want to take your profit because your analysis is going to obey till that point. The chances of card breaking this guy is slim. You can see it since this point when he even managed to penetrate here. Look at since then, there have been a lot of confluences. It cannot break through. So the recent resistance now is this point now. It has tried one, two, three, four, 5 times. It cannot break. Automatically, there's a resistance within this point. Let me mark with this thing so you see. Within this point, there are a lot of forces, a lot of resistance. Just as we have the law of gravity that is our resistance, there are some points you cannot jump to. You know, you cannot fly, you cannot float on the air because gravity stands as a resistance. You get until we break gravity, that's when we can float on the air. So this is it. all of this, there is a strong field, there's a strong force around here that is stopping Canadian dollar from selling through. So that's a food for thought. So what am I saying in essence is that taking your resistance is very, very important for you to determine your TP, your take profit. So let's go to support. Now, if you look,
Mr. Gibson, can I ask a question?
yes, please go on.
Okay. Can the is the resistance of a market fixed forever, or it can change with time?
It can change with time. It can change with time. It changes.
Okay.
But before it changes, there are a lot of, there's what we call in in the market.
And what's the time? Okay, what's the time frame of that change before you can call it a resistance?
No, it doesn't matter. There's a resistance in 15 minutes. We'll get to that. Every minute
Okay.
has a resistance like this. It just takes time for it to break through. Like now, you see at this point, if you look at this market in 15 minutes, you can agree with me that at this point here, there is something that has resisted this market from going down for the past 4 days. Today is Friday, yeah. For the past 4 days, this market has not gone beyond this point. So in your 15
Mm.
minutes, you can call this your 15 minutes resistance. I'll show you how to analyze. You can call this your 15 minutes resistance. That means this is support. Sorry, this is a support. So something has been supporting this market here, pushing it higher. So this can be your 15 minute support. All right, automatically. That means at this point, ever since this spot, the market has been making that move, and it since Monday, it has not come beneath this point. So what does this tell you? That if you are to place your SL, your stop loss, for you to be on a very safe side, you place it a little below here, because you are very sure that since Monday it has not sold past here, it's going to take a while for it to pass this point. I don't know if you get the essence of support and resistance.
Yes, sir. Yes, sir.
Yeah, so it's going to take a while for you to break through this axis to take your SL out. So that's what it actually means. All right. So we equally have what they call the support and resistance zone. Okay, so these are zones I'm bringing out to you. So what are the support and resistance zone? Support and resistance zone is that point where there is, sorry, I want to take this guy out. All right, so is that point in the market where there is a confluence of resistance and support. Let me show you an example. This is always like a region where something is fighting strongly. Let me show you an example. This guy, this is a different strategy, but I'll show you, I'll just explain. This is not like I'll explain all the strategies, but just so you know, support and resistance, this is it. Now, this is a resistance zone. The market resisted for since Wednesday till, okay, since when? Since this point, since here, this was December 2023 up till April 2024. Now, finally, the market broke through this barrier. All right. Now, breaking through this barrier, there is what they call break and retest. Now, when a resistance is broken, it gives room for a strategy called break and retest. What does that mean? There is 100% chance. It's just, for example, let me share an example with you. All right, real life now. I'm bringing someone to manually break the wall of your house. All right, the person has to manually break the wall of your house, and this wall, the wall of your house is like how it is built is that there's a first wall, there's a second wall. Now, if that person breaks through the first wall, let's assume Thor, he breaks through the first wall, all right, and succeeds. For it to break through the second wall, he needs to pull back so that he can gain strength, so that he can gain a higher punching force. If it doesn't pull back, it cannot break through the second. So there's always a tendency of pullback. For instance, let's say, okay, you are running now in a race like the Olympics that carried out that you watched, all right, that just finished. For the Olympics, if you are going on a marathon race, when you are starting, you cannot start with full force. You first have to hop. You are first hopping, like you are jogging, you are following, trying to keep up with the pace. You are following with a particular speed. You are using a particular frequency to run. At some point, there is a place where you have to pull, to push with the final force so that you can break through the finish line early as the winner. It's the same thing with the market. For this market, as this market has broken through this guy, it has broken through this guy. There is a force is using. You can see the candle, the length of the candle. These are engulfing candles. The length of this candle is so much. There is an energy is using to break this guy. It doesn't break with a small candle. It broke with a strong candle. Now that energy, for it to still continue going up, it needs to come back at some point to relax before it starts pushing up. That's just the simple logic. That's just the simple logic. So when this happens, automatically it forms a break. It forms a support and resistance. This is a resistance. Following it is a support. So this is a support and resistance zone. You can see it here. It broke through with a huge force. It came back to regain some strength. What this actually means is every activity that is happening here is the activity between buyers and sellers. Now, there were so much buyers in the market that he pulled this guy out, he broke through this guy. Now the buyers are content with what they have. They have withdrew their money, you know. They don't come out, nobody's investing in this very pair again. So they have pulled out their money. The market is now sinking back. But because of the force here, buyers are still existing in this point. Because of the force, he is trying to accumulate more buy force or liquidity, and because it has gathered enough momentum, it shoots back. I don't know if you get. So support and resistance also is a zone to watch out for when you're analyzing technical. Is it getting interesting? Am I making sense, or are we talking about the dash? Hello. Hello. Hello, can you hear me? Hello, can you hear me?
Yeah, sure, we can hear you now.
Okay. So where, like, what was the last thing you heard me say? Sorry, I didn't notice I was disconnected. So what was the last thing you heard me say? Like,
I think that maybe
okay,
just start from this line you drew here.
okay, all
I
right,
think that
great.
maybe
Yeah. So this is the resistance here, and this is the support created here. So I was using an illustration of athletes trying to catch up with pace. I don't know if you heard that point, or maybe a car.
yeah,
All right, great, great, great. And also, I also highlighted that this is be, before this market buys out here. That means there are more numbers of traders who have invested in this as buyers. There are more buyers here in the market. So the force here is great to break through. And at some point, the market is now accumulating orders before shooting up forward. So this is a support and resistance zone. So I can write here resistance, can come here and write, can come here and write support. So I can come here and call this support, just so you see. So, all right. So if we are understanding, let's continue. Now let's look at strategies. Before then, let me see what we have. Okay. I'm not even supposed to touch this now. Okay, let's look at the patterns now. Lucky us. So now, okay, we've talked about the support and resistance. Great. Now let's look at the patterns. Next class, I'll show you how we apply this fully when we start this TA. Now we started TA. Now let's look at what we call patterns. The first pattern I want us to look at is what we call the head and shoulder pattern. Head and shoulder pattern. This one is trading patterns. All right, we have a symbol here. These are patterns: head and shoulder, X, A, B, C, D, Rhombus pattern, that's the A, B, C, D pattern, triangle pattern, blah, 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 and blah. So let's look at the head and shoulder. Now let me draw something. Okay, let me use that symbol to draw. So this is the left shoulder. This is my head. I don't know if you can see my screen. This is my right shoulder. Anyhow it is. You get. So this becomes head and shoulder pattern. How? This is what it's telling you. The head and shoulder pattern tells you that. Can you hear me?
Yes, yes.
You can, we can hear you.
Now, when you talk about patterns in the market, I was trying to define support and resistance because we need it for technical analysis. This is technical analysis now. But when we go to the integral part, you know what we're talking about. Okay. So these patterns are what you actually see, the shape and formation that the candlesticks actually form. You get those shapes and formation that candlesticks actually form. It becomes a pattern, and because it is a pattern, it is always repeated. We are going to backtest this to see how it works. All right. So now we have the head and shoulder pattern. What is the head and shoulder pattern? Now, just like human being is, this is your left shoulder. If a candlestick forms a left shoulder, there is bound to be head, all right, that is higher than the rest of the shoulders, isn't it? Now, when you have a right shoulder, when you now form the right shoulder, the next anticipated move is that it should sell. Let me show you an example. Sorry, I don't want to confuse you. I'm trying so hard to stay in my lane, so I don't want to confuse. Let me use line, trend line. Let me use trend line. So I call this guy neckline. Alright, so you can draw this or however you want. So this is very simple. Now let me show you an example of head and shoulder pattern. This is why I use the chart. I use the line chart. I don't use candlestick so that I can confirm it clearly. So this is it. Let's see. Let me keep it in daily so we see the strong one. So I'm going to put it on line charts. Even without showing you, you should see. There is head and shoulder, there is inverse. Inverse is the opposite. This is inverse. But let me show you a clean head and shoulder pattern, which we can call head and shoulder. So once it forms, it sticks in the market. I don't want the one that will, okay, clean. So this guy, all of this guy, Now let me show you how it is head and shoulder. Let's confirm with our charts so you see it. Alright, so where's the head and shoulder? Pick it up from here, pick it here, pick it here, and that's it. So if I go back to line charts, this is what I'm getting. So let's bring this shape out now. So this is it. Alright, so assuming all of this did not happen, you see this line here. This is automatically the symbol has drawn, the tool has drawn the neckline for you. Now, assuming this did not happen, the market is at this point currently, and you happen to see this formation. It formed left shoulder, came back here, formed head, came back here and formed a right shoulder. Now, without you being told, there is a neckline here which this guy has drawn for you. It therefore tells you that there are certain things you need to watch out for in the market, which is the break and retest. We'll look at that. So this is it. Now the market created left here, right here, created right, head here, then right here. Now the market coming down here, you know, and to this point, then did any reverse, like after the last right shoulder, you find this is the last right shoulder and you find another reverse. It is telling you that the market is going bearish because that shoulder needs to drop its hand down. So this is it. This is the point you have marked as our resistance, right? You can see for safety, like I said, it sold down till that closest resistance, even past but there is no guarantee that it's going to go further. So it sold back up. You see it. So the point it sells to surely is the closest resistance. All right. So what is the head and left shoulder? Anytime you see a head and shoulder pattern, it shows it is an anticipated move for a sell. For a sell move, it's telling you, Papa, go sell. That's short the market. That's what it's telling you automatically. Oh, I've gone off from there. I've left that point. I was so this is it. You get. So anytime you see the right shoulder formed, okay, I'm still in the class. So anytime you see the right shoulder formed, it's telling you that you should anticipate a short market. It's telling you to sell, telling you, Oga, sell. So this is it. Just like we have head and shoulder, we have the inverse head and shoulder pattern. So let's just keep looking. Inverse, opposite. Mind you, patterns have a 60% chance or 50% still of occurring. But if the pattern is, you look at it and you see that, okay, this very market obeys this pattern, you stick to it because there are some markets that the algorithm is following a particular pattern by default. You stick to it. So that's just it. So at this point, if I should go to weekly, we'll find it here. So this is weekly. Okay, cancel. Let's go to 4 hours. So we're looking for inverse head and shoulder pattern. Now, assuming I'm in this market and I want to trade patterns now, I can see this as a pattern. Let me see use the head and shoulder. I can see this as a pattern. How? Left shoulder, head, right shoulder, then it's selling till this point. It's buying till this point. So I can call this inverse head and shoulder pattern. So this is just what it actually means now. So if I'm to trade this market using the pattern rule, it therefore means that I'm anticipating a buy market. Let's be sure of that if this works. So let's go to our technicals. Let's see what people are postulating on this. This is 4 hours time frame. So let's go. So let's see. This is if I'm trading patterns, you get. So let me show you because this is what I feel like I've seen. I'm feeling like okay, I have seen head and shoulder inverse. Although it's not clear, but to me, I'm feeling like they have seen it. So that's it. So let's see technicals first. So great. So on a 4 hour time frame, you can see where the oscillators is. It's not a strong sell, neither is it neutral, neither is it a buy. So there's a high chance that this market is undecisive, is indecisive. Same thing here on the moving average is giving you this stroll down again. On 2 hours time frame, you see the indicator is telling you that okay, oscillator is telling you that it's neutral. It does not have a decision. That's in the next 2 hours, it does not predict, know where the market is moving. On a 2 hours moving average, it's telling you it's a buy. Let's go down to 1 hour. That's 1 hour from now. There's going to be a strong buy in this same market that we are in 4 hours. A strong buy, and that strong buy most likely can push this to this point, or this is it. Neutral oscillator is still neutral. Oscillator is not saying anything. The moving average is telling you something. All right. So what am I saying in essence is you trade what you see. Like me now, I'm assuming I've seen this guy, but if you check, this is not a very clear inverse, a very clear head and shoulder, right? Let's see what people are saying about that. You see someone come up with something. Someone might come and say inverse head and shoulder. Okay, see, he's marking it. Let's see someone's decision saying is a buy till this USD card. This guy too is saying is a buy. You go long. You have to check his time frame. This one said a sell. August 22. This is old. This is the guy we saw last. This is 26. Today is 30th. So anticipated.
How do you check that time frame? How do you check that time frame?
Okay, this is it. Ah, Ruben wants to do Ojoro in market. This is it. Once you click it,
No, no.
you can see this guy now. This is the inverse head and shoulder is showing you left, right. Is drawing it out, but it's using ICT terms now. Left, right. This is the head, the left, the right. It's telling you it's buying here. Now 15 minutes. This is a 15 minutes time frame. He's viewing it from 15 minutes. This is the entry. All right. So let's go back. Let's see what this guy said. This guy said this is 1 hour time frame. He dropped this when okay, that first guy is charts. The market has already surpassed. This is an old market. So this one dropped 10 hours ago under 1 hour time frame. So this is still real, it's still existing. While this one dropped today is what 30th. So let's see the most recent analysis. 29th, 29th. Okay, 29. This one 14 hours ago. It's telling you go short. It's telling you to go short when the market reaches this point. Go short. This is 1 day analysis. That means it's telling you that the market will buy to this point. That's there's an order block here. It's an ICT term. It's using ICT. All of these are ICT terms. We look at that. This market structure shifts. This is fair value gap, order block. This is liquidity gap. We'll look at all of that. Yeah. So this guy trading here up to this point is telling you to sell, right? So he's telling you that this market will buy up to this point before selling. So him as an ICT trader, he trades order block. So you are seeing an order block here and he's anticipating it. Whereas the retail traders they are seeing inverse head and shoulder. some retail traders are seeing as it as invested and shoulder, telling you that the market will buy till this point before selling, whether it will sell or but their own profit is to take from here till here. So that's for head and shoulder. Let's look at other occurrence. Let me look for a clean one that occurred so you get to see 733. Okay, so let's look for a sharp one. All right, so this guy here, I can call this inverse head and shoulder because it has formed a left shoulder here, head and right. Let me look for a clear one. Let me look for and go to another chart that does that very often. JPY pairs uses that shit very often. So let's go there. So this guy always obeys principle. So let's bring it bit, down a bit. So the Asians often play by this policy. So let's see what we've got. Okay, let's see when it happens. Let's go to 15 minutes. 15 minutes. So this guy, this is a clean inverse head and shoulder. One left, one right. You see where it hits to. This is a clean. If you use the line chart, clean representation. So at this point, people have seen this guy that it has formed it completely. They took a buy from here to here. They make cool profits. That's for retail traders. You know, people who trade ICT are called institutional traders. Not that they're trading with too much money, but they are practical and careful traders. This is it. Left, right, but not too clean like the other one. Let's look for the okay, this is it. This guy. Head, left, right. So let's look for another occurrence. This guy is not too clean. So if I were the one, I'll not go in. This guy. Left, left, left. But however it is, however you find. So you can backtest as many as possible. This is it. Left, head, right. But so there is a formation. Yeah, this guy clean. Head, left, right. Sold. So that's this is it down here too. Head, left, lap, but so this is just to start up so that I can be looking at the charts, looking out for something, then you can know that okay, you've started your journey to analysis. So this is it. Head, left, left, but so I'll show you another one I used one time to flip still retail trading. I used it so much to flip. I flipped $80 to about 1,200 then. Not like flip, but I was consistent with it. And I got a message from Octat FX. Then, very funny people. You know, when they have observed your trade that you are very consistent in profit, there's one message you'll send you. When you get it, you get there. So this, let's go back to another style I want to show you. Another pattern is what I call this one. I just I just coined it because it was working for me. It was working for me, so I just gave it this name. I know it exists. I don't know if it exists, so I call it my life strategy. What is it about? MW pattern. I just gave it the name. Just forget the name, but I just it's a pattern. All right, so I just call it that way. It helped me a lot. So what does it do? The M here, anywhere you see the market at some point, the market will always form this guy M and W. If you look at it in a line chart, you always be seeing W, you always be seeing M. You see it form like an M. You see it. You see it do like a W, something like that. You see it hits like a W, something like that. Hits like a W, hits like a W, hits like an M, you know, stuff like that. So each time an M is about to be formed, there is a high chance that it's going to sell. You see an M forming, that second part of the M form like this guy, he violated it here. He's supposed to buy right, he's supposed to sell to this point. That's according to retail traders. Like this guy now, he's supposed to sell to complete the leg of this M. Like this guy now, supposed to sell. So this one happens 70%. In fact, 80% self. It works. This is it. Sells to this guy. Once it forms, sells to this guy. Always. W, once it forms, sells to this guy. And there's a policy for it. When an M is completed and the subsequent one that is starting, if it's a W, is not going to form because an M just got completed. Like this guy now. At this point, you feel like, okay, let me buy because it's going bad. Yet it made another pattern here. It formed head and inverse head and shoulder before it went there. So let me not bamboozle you with so many things. We will continue this tomorrow, but just note the following. For today's class, we have learnt about candlesticks. We've learnt about candlesticks. We've learnt about uh, what else? About patterns. And those patterns we looked at head and shoulder. Then we've almost looked at M and W pattern. So next class, please remind me, you can write it down. We'll start with double top and double bottom. Alright, that's a pattern two. We'll now look at Rhombus pattern. I pray I remember. All of these are just I don't like this approach, this Rhombus. So let's see. There's so many of them. So we have the rectangle pattern. There are so many. There's one that happens once or twice a year. The camel pattern. All my years, it's just once I've seen it. It's just once. Uh, let's just note all of this. So we'll touch it as I remember. So let me just search. So you see trading patterns. I don't want to miss anything. Trading patterns. Okay. So these are the names. People have different names. So we have double top, double bottom. Alright, we have ascending and descending staircases. Different name. This ascending and descending staircase can be that M or W. We will see it. We have ascending triangle. We have triangle pattern here. We have head and shoulders. We have rounded top or bottom. We have cup and handle. So different people. Let's just go back. Let's see another person's naming for it. So that you not be confused and be like, this guy taught me this. He didn't teach me this. This is head and shoulders, double top, double bottom, rounding bottom, cup and handle, wedges. So we look at all of it. All of it. Next class. They didn't even mention rainbows here. We have channel self. Channel is a pattern too. So that I don't forget channels. So that's it. All of these we are going to look at it exhaustively. Then we now move. Once we are done with that, we start we come back to this guy. Now I've touched support and resistance. Now you understand how to spot it, but I'll look at it and how you apply it in your analysis before we start trading lines, trading view, channels, market structure. We look at start a touch of ICT. We talk about supply and demand curves and break and retest. This is for retail. So I'll touch it in the pattern small, then we still look at it, then we do live analysis, and that is that. So next class we will spend more than 2 weeks here. More than we spend some time here till we get it right, like 2 weeks or 3 weeks. then we come here and do. So one of the classes, one of us or each of us will do an analysis. Everybody will check, we argue, and we are going to place trade. At the end of the session, some all of you will give signal. This one is going to drop a signal. We'll use live account. Me too, I'll use my live account. I'll take the trade. If I'm convinced after we've had a session like this, if I'm convinced though, I'll place the trade, drop it on the group. Everybody see you place yours, drop on the group. That's how we progress. So inshallah, so that if you fail, if you make us fail, you know that okay, it's your signal. We tell you where you got it wrong. That way you learn and you keep moving. There's no perfect analysis. When we get here, when we get to there's a point. Okay, when I start sharing the mistakes I make, and here, this is where you get to learn more. You understand the integral part of it. You know, there's some months that I stay. I don't go to the market because those points, my psychology is fucked up. All right. Then we take Profem test at the end of this class. Each of us will take, even myself, we take each of us. Yeah, will take Profem. So we are setting our Profem test at the end of this class here. So live trading, then final tips. Then we proceed. Then we onboard you to the.
That profile test is hard. Oh.
No, we'll take it. Profem test helps you build discipline. Because it's doing Profem test now. We look at what we call the trading plan. All right. So I used to have, let me see if I still have that my this thing. I have a trading plan. I used to create, then I created one time. Let me see. So let me check. Trading, challenge journal. So that is it. I created something like that. I didn't even implement it. Let's see. Let it load. Okay, let me check the other plan. Let me see it. I created something for myself, Sha. When I joined one business trading this thing, HB. Okay, this one is Martin's own. You see here. So this is the one I used with our team. So is this guy, this is a trading plan I created and we've been following it strictly. So the dates we traded this guy, we have a plan outlined. The lot size I use, the stop in pips, you see how professional it looks. The risks I'm taking, the news. This was for a Profem. I passed it Shabbat. Profem messed with me one time. They closed down, they shut down. And when I was supposed to fucking withdraw my money, I used the effort on the live trading. Let me end this session before I start saying things.